Hey everyone, welcome back to We Are Cosmic, the channel where we break down the world of finance, cryptocurrency, and the hidden patterns driving the global economy. If you've ever felt like the financial ground beneath your feet is shifting, you're not imagining it. Today we're diving into something huge, XRP, the crypto that's quietly moving from a speculative token to a cornerstone of the new financial system. By the end of this video, you'll understand why what's happening right now could be one of the most important moments in crypto history. For years, XRP was all about hype, court battles, and dreams of a massive price spike. The community was loud, optimistic, and never ready to give up. But as we step into January 2026, the story has changed. The noise of speculation is fading, replaced by something much more concrete, the slow, steady activation of a global financial engine. And if you clicked on this video because you felt something big was happening under the surface, you were right. This isn't just about price anymore. This is about the structural role XRP is starting to play in global finance. Let's start by understanding the shift. The broader crypto market has been volatile, with Bitcoin and Ethereum moving unpredictably. But XRP? It has carved its own path, outperforming both Bitcoin and Ethereum in the opening week of 2026. This isn't a random pump. It's the result of institutional strategies quietly building behind the scenes. The launch of XRP spot ETFs in late 2025 created a flow of capital unlike anything we've seen before. For over 43 consecutive days, no money left these funds. While Bitcoin ETFs faced billions in selling pressure, XRP quietly crossed 1.4 billion in total assets under management. Now, that may sound like numbers on a screen, but here's why it matters. We're seeing a real reset in real time. The shift from meme-level speculation to institutional control is happening right before our eyes. In the first week of January 2026 alone, XRP surged 27%, while Bitcoin gained just 7% and Ethereum stayed range-bound. That's a massive rotation of wealth, moving billions into the XRP ledger ecosystem, and it signals a deeper change. The market is starting to value XRP not just as a coin, but as a tool for global finance. Jake Claver, CEO of Digital Ascension Group, explains this brilliantly. He points out that for XRP to be the backbone of the next generation financial infrastructure, it must satisfy 4 core requirements: price stability, network reliability, transactional volume, and institutional support. And the numbers today show XRP is hitting these marks. Exchange reserves are at a 7-year low, circulating supply is shrinking due to ETF accumulation, and institutional mandates are executing. Think about that for a moment. Institutions aren't chasing hype. They're strategically positioning themselves to control the pipes of global finance. While retail investors are focused on the next meme coin or AI token, banks and corporations are quietly integrating XRP into core financial operations. This isn't speculation. This is the engineering of a financial tool. And here's the big takeaway for today. If you want to understand where the market is going, you need to start thinking like an institutional investor. Forget moonshots and viral tweets for a second. Focus on utility, infrastructure, and access. The institutions are building the foundation now, and when the public realizes it, most of the liquidity will already be locked away. That's why this moment is crucial, because understanding it today puts you steps ahead of everyone else. So if you're ready, buckle up. In this series, we're breaking down XRP's journey into the Great Reset, explaining the ETFs, the Clarity Act, the liquidity flows, and the silent accumulation happening in private corridors. By the end, you'll see the full picture and why XRP isn't just a crypto. It's becoming the backbone of the 21st century financial system. Now that we understand the big picture and why XRP is moving from hype to utility, let's dive deeper into the numbers and mechanics behind this transformation. One of the most important drivers right now is the spot ETFs launched in late 2025. These funds aren't just a way for investors to buy XRP. They act like a massive liquidity vacuum. Once institutional money enters these ETFs, it rarely leaves. Over 43 consecutive days, there wasn't a single dollar of outflow from these funds, which is practically unheard of in crypto markets. To put this in perspective, Bitcoin ETFs have been under selling pressure, sometimes losing billions in a single week. Meanwhile, XRP ETFs quietly crossed $1.4 billion in total assets. This isn't random. It's a strategic move. Institutions are building a wall around the available supply of XRP, creating a controlled environment where retail traders have less influence on the price. Simply put, the public market no longer drives XRP, the institutions do. The impact of this accumulation is visible in the price action. In the first week of 2026, XRP surged 27%, dwarfing Bitcoin 7% and leaving Ethereum behind in a narrow range. But this is not a wild pump. It's the direct result of billions of dollars flowing into XRP ETFs, signaling a massive rotation of capital from speculative coins to an asset with real structural utility. Institutional players are not chasing hype. They are securing a tool for the global financial system. Let's look at supply. Exchange reserves of XRP are at a 7-year low, down to 1.6 billion tokens. ETFs remove roughly 1% of circulating supply every month, and these tokens are effectively locked away from the public. At the same time, institutional mandates are forced to execute, creating a natural supply squeeze. In simple terms, fewer tokens are available to buy, and more institutions are competing to hold them. This is exactly how a stable upward price trend forms. Another key point is wallet concentration. Data shows that retail addresses holding less than 10,000 XRP have decreased by 18%, while whale addresses holding over 1 million XRP have increased by 24%, now controlling nearly 70% of the circulating supply. What does this tell us? The weak hands are gone, replaced by entities that don't trade based on emotion. These are long-term players who are in the market for strategic purposes, not short-term gains. Institutions are also indifferent to exact entry price. Unlike retail traders, they are focused on utility access. They know XRP will be necessary for cross-border settlements and liquidity management. Whether they buy at $2, $100, or even $1,000, they are not chasing profits. They are building infrastructure. This mindset shift is critical. The market is no longer about speculation. It's about control, access, and system-wide efficiency. We also need to understand the mechanics of the XRP ledger. XRP can handle 1,500 transactions per second with final settlement in 3 to 5 seconds. It does this without the energy drain of Bitcoin mining. This efficiency allows it to process over 2 million on-chain transactions per day, exactly what large institutions need to move trillions in capital that are currently stuck in outdated banking rails. In other words, XRP is designed to free dead capital, and institutions are positioning themselves to benefit from this efficiency. Finally, the takeaway here is simple. The combination of ETF accumulation, reduced exchange supply, whale dominance, and institutional strategy creates a unique environment. Retail traders no longer control XRP. The asset is maturing from a speculative coin into a strategic tool for global finance. And as supply continues to tighten while institutional demand grows, this structured setup is setting the stage for a major shift in the market. As we continue, it's important to understand that XRP's transformation isn't just about ETFs or supply constraints. A huge driver behind its structural value is regulatory clarity. For years, XRP faced uncertainty in the United States. Was it a security? Was it safe for banks to hold? These questions kept many institutions on the sidelines, waiting for clear rules before committing billions. That uncertainty has now largely been resolved with the Clarity Act of 2026. The Clarity Act provides a legal framework for digital assets, categorizing them into 3 tiers. XRP is officially recognized as a Tier 1 utility asset, which is a game changer. This designation allows national banks to hold XRP on their balance sheets for liquidity purposes without punitive capital requirements. In plain English, banks can now legally and safely use XRP for settlement and liquidity, removing the biggest barrier to mainstream adoption. Why does this matter so much? Because global banks operate on tight regulatory rules. They can't experiment with assets that could land them in legal trouble. Now, with the Clarity Act in place, XRP moves from a speculative token to a fully compliant tool. This is the difference between a bank testing RippleNet for small payments and integrating XRP into its core settlement system for billions in daily transactions. The timing of this legislation is also strategic. It aligns with the rollout of ISO 2022 standards, which are modern global banking standards for financial messaging. The world is moving towards a uniform system for faster, more transparent transactions, and XRP is uniquely positioned to meet these requirements. No other cryptocurrency has this combination of regulatory approval and technical readiness. We are already seeing banks take action. Over 45 US-based regional banks have begun public pilots for cross-border settlement using XRP, targeting nearly $800 billion in annual transaction volume by the end of 2026. And it's not just the US. Other G20 nations are racing to harmonize their own regulations to stay competitive, creating a global demand wave for XRP. This is why XRP isn't just a token, it's becoming the digital bridge for international finance. Here's another important point. The old system of Nostro and Vostro accounts is highly inefficient. Banks currently pre-fund accounts around the world with trillions of dollars just to ensure transactions can settle. This is dead capital doing nothing for the economy. XRP changes that. By using XRP as a bridge, transactions that once took 2 to 5 days and cost up to 7% in fees can now settle in 3 seconds for less than a penny. This is real-world impact, not just chart speculation. Ripple's CTO Emeritus, David Schwartz, has been building this system for over a decade. He emphasizes that institutions are starting to see the benefit of on-chain settlements, faster, transparent, and highly efficient. This isn't about hype. Banks are integrating XRP because the cost of not using it is higher than the risk of adopting it. By early 2026, Ripple's on-demand liquidity, ODL, has expanded to over 55 countries, with 40% of RippleNet's 300 banking partners actively using XRP for settlement. The volume is staggering. Over $1.3 trillion processed in a single quarter, a 32% year-over-year increase. This scale demonstrates that XRP is not just speculation, it's becoming a critical infrastructure for global finance. The takeaway for investors is clear. Regulatory clarity has unlocked institutional adoption, which drives structural demand. XRP is no longer fighting a legal gray area. It is legally empowered, technically ready, and strategically positioned. This is why the combination of ETFs, reduced supply, and regulatory certainty makes XRP fundamentally different from other cryptocurrencies. Now that we've covered regulatory clarity and bank adoption, it's time to focus on liquidity and supply dynamics, which are crucial for understanding why XRP is positioned for a major structural reset. Institutions aren't just buying XRP, they are locking it away, creating a scenario where supply is shrinking while demand grows. This is the kind of setup that rarely happens in any financial market. The spot ETFs we discussed earlier act as massive vaults. Once XRP enters these ETFs, it essentially disappears from the open market. Over 43 consecutive days, there were no outflows, which is almost unheard of in crypto. This shows that the current holders are not retail speculators. They are strategic allocators who plan to hold XRP long term. In other words, they are building a wall of money around the asset, making it harder for new buyers to access the circulating supply. Look at the numbers. Exchange liquidity for XRP has hit a critical threshold, with only about 4% of the total supply available for immediate purchase on top-tier exchanges. Meanwhile, institutional demand through over-the-counter OTC desks has grown by 300% in the last quarter. The math is simple. Fewer tokens are available for retail traders, while large institutions control the majority of supply. This creates a programmed supply squeeze, a key factor in any major price move. Wallet data confirms this shift. Retail wallets holding less than 10,000 XRP have decreased, while whales controlling over 1 million tokens have increased their holdings. These whales now control nearly 70% of circulating supply, which is a huge indicator that XRP is maturing from a speculative coin into a strategic financial asset. The weak hands are gone, only serious, long-term players remain. Institutional accumulation also isn't random. These players don't care about short-term price swings. They are focused on access to the asset and the utility it provides. Jake Claver, CEO of Digital Ascension Group, emphasizes that institutions are indifferent to exact entry price. Whether they buy at $200 or even $1,000, their focus is on securing access to XRP's transactional utility. This is a huge difference from retail traders who often panic sell during volatility. XRP's ledger itself supports this strategy. With 1,500 transactions per second and 3 to 5 second settlement times, it's capable of handling large institutional flows without slowing down. This efficiency allows XRP to process millions of transactions daily, making it a ready-made infrastructure for the $27 trillion currently stuck in pre-funded accounts across global banks. Essentially, XRP is not just a currency, it's a tool for unlocking trapped capital. Another factor amplifying the squeeze is the on-demand liquidity ODL expansion. RippleNet now operates in over 55 countries, with 40% of partners actively using XRP for settlement. This creates a feedback loop. The more institutions use XRP, the more demand grows, while the circulating supply continues to shrink. In simple terms, XRP becomes harder to get, which increases its strategic value. Spot ETFs, private custody, and NDAs signed by Ripple create another layer of scarcity. Over 1,700 non-disclosure agreements are in place, meaning that private partnerships, corporate pilots, and banking integrations are happening outside the public market. By the time the public becomes aware, most of the liquidity is already locked, leaving the market to deal with the supply shock. Here's the takeaway. The combination of ETF accumulation, whale dominance, ODL expansion, and private institutional deals creates a controlled scarcity environment. Retail traders are largely spectators, while the real structural changes happen in private corridors. The Great Reset isn't hype. It's being engineered through liquidity management and institutional strategy. Now that we've covered institutional accumulation and supply dynamics, it's time to focus on why XRP isn't just another crypto. It's infrastructure. The real story of XRP's value lies not in price charts, but in its technology and utility. For banks and large financial institutions, efficiency and reliability matter far more than hype. XRP delivers exactly that. The XRP ledger is capable of processing 1,500 transactions per second with final settlement in just 3.5 seconds. Unlike Bitcoin or Ethereum, it doesn't rely on energy-intensive mining, which keeps transaction costs extremely low. This efficiency allows the network to handle over 2 million daily transactions, providing the throughput necessary for trillions of dollars of capital currently stuck in outdated banking systems. Here's why this is significant. The traditional cross-border banking system uses Nostro and Vostro accounts, which are pre-funded accounts sitting idle around the globe. Banks currently park an estimated $27 trillion in these accounts just to ensure payments can settle. This is dead capital, money that isn't earning returns or stimulating the economy. XRP changes that. By using XRP as a bridge, institutions can settle transactions in 3 seconds for less than a penny, potentially freeing up nearly $30 trillion for lending, investment, and economic growth. This is the essence of the Great Reset, moving capital from slow, costly, and outdated rails into a real-time, highly efficient digital infrastructure. XRP isn't about speculation anymore, it's about unlocking systemic efficiency. Banks don't care about volatile price swings, they care about access, liquidity, and reliability. XRP's track record of zero downtime in 13 years and over 300 global banking partnerships makes it uniquely positioned to support this transformation. Ripple's on-demand liquidity, ODL, is another critical component. By early 2026, ODL has expanded to over 55 countries, with 40% of banking partners actively using XRP for real-time settlement. In one quarter alone, over $1.3 trillion moved through the network, a 32% year-over-year increase. This is a tangible demonstration of XRP's role as a bridge for global capital. Not hype, not speculation, but a working financial tool. The combination of technological efficiency and institutional adoption creates a feedback loop. As more banks integrate XRP, liquidity moves off exchanges and into private vaults, creating a supply squeeze that supports long-term stability and growth. Unlike retail traders, these institutions are indifferent to short-term price fluctuations. They are focused on building redundancy, ensuring they have multiple on-ramps, off-ramps, and custody solutions in place to handle the sudden flow of capital during the reset. This is where the math behind XRP becomes clear. Efficiency plus scarcity plus institutional demand equals structural value. The retail market sees price swings and speculation, but the real action is happening quietly, behind the scenes, as trillions of dollars prepare to flow through the XRP ledger. The Great Reset is not a single moment. It's a carefully orchestrated shift in how global finance operates. And it's not just the US. With regulatory clarity provided by the Clarity Act, other G20 nations are aligning their own frameworks, creating a global race to adopt efficient, compliant digital payment systems. XRP sits at the center of this transformation, legally recognized, technologically capable, and strategically integrated into institutional processes. For everyday investors, the takeaway is simple. XRP's true value lies in its utility, adoption, and efficiency. It's no longer about chasing a moonshot. It's about understanding that the system itself is being rebuilt, and XRP is the tool that allows it to function smoothly. Those who grasp this now are the ones who will understand the next phase of growth long before mainstream media catches on. Now that we understand how XRP is being adopted by institutions, locked into ETFs, and positioned as a backbone of global finance, the question becomes, what does this mean for retail investors? Simply put, the rules have changed. XRP is no longer a coin you can trade on hype or hope for a quick moonshot. The focus is now on access, security, and professional grade positioning. One of the most important lessons from institutional behavior is the concept of redundancy. Banks and high net worth investors don't keep all their funds in a single account or exchange. They spread assets across multiple platforms, custodians, and wallets to reduce risk. Retail investors should adopt the same mindset by having accounts on top exchanges like Binance, Kraken, and Bybit, and keeping some XRP in secure hardware wallets. You ensure that you are never locked out when liquidity moves or technical issues occur. Historical data supports this strategy. During past periods of high volatility, 68% of major crypto exchanges experienced service disruptions or withdrawal delays. Retail traders who relied on a single platform often missed opportunities or were unable to access their funds. In contrast, users with accounts on multiple exchanges were able to capture 4 times more arbitrage opportunities and secure an average of 12% more value during sudden liquidity events. This is the practical side of thinking like an institution. Another key point is patience. The Great Reset is not about short-term price gains. Institutions are focused on long-term utility. ETFs, NDAs, and strategic accumulation are creating a market where supply is shrinking, demand is rising, and volatility is less about speculation and more about structural shifts. Retail investors who try to trade like institutions without preparation risk losing out. The focus should be on building access and being ready for the systemic changes underway. Speaking of NDAs, Ripple has reportedly signed over 1,700 non-disclosure agreements with corporations, banks, and governments. This private adoption is happening outside the public market, meaning that by the time mainstream news reports it, most of the liquidity is already in institutional hands. Retail investors need to understand that the visible price is only part of the story. The real action is in the private corridors, quietly shaping the financial system. Practical advice for retail investors includes diversify access, use multiple exchanges to ensure liquidity and execution capability. Use hardware wallets, secure a portion of your XRP in cold storage to avoid dependency on online platforms, follow the fundamentals, focus on regulatory developments, ETF flows, and ODL expansion, rather than short-term price speculation. Adopt a long-term mindset. Institutions are in this for the systemic utility, not quick profits. Think in terms of years, not days. Stay informed. The more you understand how XRP integrates into global finance, the better you can position yourself. By applying these strategies, retail investors can navigate the Great Reset safely. The reset isn't a sudden event, it's a series of coordinated shifts in liquidity, regulation, and adoption. Those prepared with proper access and security measures are positioned to participate in the structural growth of XRP, while those relying solely on market timing may find themselves sidelined. Finally, the big picture is clear. XRP is moving from a speculative asset into a strategic, institutional-grade financial tool. The ETFs act as vaults. The Clarity Act provides the legal certainty, and global banks are integrating XRP into settlement corridors. For retail investors, the opportunity isn't chasing a price spike, it's building the infrastructure, access, and understanding to participate in this historic shift. In conclusion, the Great Reset is happening quietly, but its effects will be massive. XRP isn't just a cryptocurrency anymore, it's becoming a fundamental layer of the global financial system. By thinking like institutions, adopting redundancy, and focusing on long-term utility, retail investors can safely position themselves to benefit from the next era of global finance.